Okay, folks, some major stock market signals and bond market signals are coming to us. You need to understand this. What is happening to stocks? What is happening to Bitcoin? This is Pablo He-Man coming from Bahamas. We're coming from Bahamas this time. How about that? So yeah, the hunt for what's his name? For Sam Bankman-Fried continues. So basically, if you're in my Discord, I think you'd be aware that I've been talking about a couple of big signals coming in right now, and it's what we call risk on, risk off. There's basically a situation that the market is in where it's risk on, which means people buy risk assets such as tech stocks and crypto, or risk off, which means people buy things which aren't risky, like bonds or utilities, and instead, and they sell crypto and they sell stocks. So what kind of situation have we been in for the last few months, few weeks? Where are we heading to right now? If you've been watching my last video, I've been saying that this situation looks quite like the May to July situation on the from last year on Bitcoin. So where is Bitcoin? Let's say USDT. Yeah, okay, here's the daily chart. So if you remember from my last video, I've been saying this dropped down to 30,000. This is on a daily chart, by the way, and basically took like 1, 2, 3, 4 tests and then bounced up as it was sort of almost a wedge pointing down. In my last video, I said, hey, that's actually quite similar to what's happening to us right now. 1, 2, 3. I thought it would bounce. Then it pulled back and did a little fake out. But in my Discord, I was telling this line and this line. So basically, it's a downward trending triangle, and it is still quite possible for a breakup because everyone was too bearish. So on a breakup, I think it would continue, and that's actually what's played out. So just to keep in mind, this is another reminder that the markets can always fake you out. This was a perfect plan. The market went almost exactly the way we thought it would. But you can see that it still got faked you out to the downside and then bounced up. So looking at what happened in May to July last year, you can check the charts for yourself as well. I just shown it just about 2 minutes ago. What I'm expecting is probably like a little bit pullback to around 16.6, or no pullback, essentially for the continuation. And the big test is going to be around the 18.2 to 18.7 this year. So I'm expecting a bounce to about there, then see what happens. Then it might go sideways and go down. Then, probably. So I'm saying there's probably a little bit more of a bounce to come. Why am I saying this? Okay, first of all, let's have a look at something we call the net taker buy sell volume, which is you know how when you're trading and there's a bid and an ask, right? If you just put in your bid, you wait for the ask to hit your bid. You want a lower price. But if you're in a hurry, you actually just say, whatever, I'll move up my bid to hit the ask, right? You close that gap. So that's what they call net taker. So if the more people move up their bid, and then there's a net buy taker, right? Vice versa. If more people lower their ask to sell it, then there's a net taker of sell volume. So what's happening recently is that we've noticed that we've had, this is net taker buy volume, this is net taker of sell volume, and we've noticed that, of course, on this move down to, say, 20 to 15.5K, this is the entire FTX crash. We noticed that even before it made the move, the market started going to net taker or sell volume. Some whales were eager to get out, so they kept on, whilst the small fish, the retail have been buying, they pushed the price down. They've been actively selling into it, and then price followed. But now, as price bounced a little bit, look how much this recovered. It's about to go into green again. We can see that it's not just about red or green. We can see the shape of it. As this slope declined sharply, right, it gave us a signal that more drops are coming. And then as this, the red was rising, almost going to green, we saw this bounce was coming. Okay, so this is telling us potentially, again, backing up my theory that I think the bounce could continue to maybe 18.2 to 18.7. If it gets even above there, if it gets above 18.7, that's entirely possible as well. But for now, let's say our next target is 18.7. Can't rule out the market, going even above and hitting 19K. Okay, so this is the longer term chart. You can see that that basically it's not 100% accurate, but it is helpful to know when the market is going into a seller volume, right, or a buyer volume. See, for example, when it hit 64K, it was basically lots of selling. When it hit 69K, basically lots of selling. I would just point out, though, keep this in mind. Last time we had this seller volume, and as it was improving, you think, oh, things are getting better. It's buying opportunity. If you bought here, say this is around May this year, sorry. This is around, say, May. If you bought here as these numbers were improving, as the seller volume was improving, you would have gotten crushed, right? So it doesn't work 100% of the time, even though it's very helpful. Just because what happened here was, that was actually, if you remember, the May crash to 17K was because of the 3AC crash and the lunar crash. So that was entirely possible. It's something that comes out of the woodworks. It's just like a bit of a surprise. So the market wasn't prepared for it, and it could have easily happened again. We could potentially have a number more blow-ups around here. Okay. Let's see what else. Okay, so the main point I want to make about this video is about this risk-on, risk-off signal. And I've been explaining this a lot in my Discord lately. And by the way, videos like this always go into my Discord first, and then after about 48 hours, I release it to the public. So when you do see it, it's possible you're probably seeing it about 48 hours late. But, thousands of people in my Discord have seen it already. Okay, so the concept here, is this. There is something we call risk on, risk off, which I explained at the start of the video. And if we look at the last 20 major drawdowns, not necessarily bear markets, but major drawdowns in the SP 500 since the 1960s. So this has been 60 years for the last 60 years. Check this out. We have seen all these pullbacks or drawdowns or crashes in the SP 500 in the stock market, because we're looking at this because it's highly correlated to the Bitcoin and crypto market, right? This was down 27%, down 20%, down 32%, down 44%, down 14%, down 12%, down 16%, down 20%. See, because every time when it goes down, you notice that SP 500 only goes down something like, where is it at now? 24%. Come on. It's only down 21.5%. And yet Bitcoin's down like 80%, right? 78%, and most of the cryptos are down 95%. So we need to understand this. The purple line, however, is the 20+ year treasury bonds. It's a longer yield bonds. You can have 2-year bonds, 5-year bonds, 10-year bonds. These are 20-year or longer bonds. They're much more sensitive. And a lot of rich folks likes to, big institutions like to have them in their portfolios. It's what they call the classic portfolio, called a 60-40 portfolio. This is how most managers think. Because, see, what they would do is, What they would do is basically hold in their portfolio 60% of their money in bonds and 40% in stocks. Why? That's because they're already rich. They're just trying to keep their money churning, making like say 5 to 10% a year, and beat inflation. That'll be great for them. They're not trying to 100x their money. These are rich folks. So if you imagine this scenario, if you have 60% of your money in bonds, what do? What happens to you? What happens is basically every time there's a big crash, right, most of your bond money is protected. In fact, look at these major crashes, right? 44%. This was 1973-74 crash. Bonds are only down 8%. In this 2000 .com crash, down almost 50%. 2009, GFC crash, down 55%. Bonds, that part of your portfolio actually went up. Look at how often, right? This is a bear market. Bonds went up 20%. How often, look at recent history, right? Since 2000, since the .com bubble, every time stocks went into a major drawdown, your bonds bounced and saved you. That's why rich people, they think about buying bonds, right? And they're collecting that yield. But what's unusual is, look at this. We've had a bear market. Come on. We can see here, it's down 21%, 21.5%. Anything over 20 is technically defined as a bear market. But look at the purple line here. The purple line is actually down. Come on, this stupid bloody thing. The purple line is actually down 27. You can see that, right? 27%. So basically, it's the largest drawdown for bonds in all these SP 500 pullbacks or bear markets, and that's not normal. That's not usual at all. It hasn't happened before. I don't know if you would look further back in history, what would happen. Now, usually, what we would call a risk-off situation is when money actually flows into the bond market, because the bonds are seen as being safe. See, as we've seen how bonds behave during all these crashes, bonds actually go up or they fall very little. So classically, judging from experience from the last 100 years, if we're looking for a major stock market crash, we're looking for big money, safe money to fly into bonds. We're looking for that flight to safety. Okay, so flight to safety. Now, so far it hasn't happened yet. In fact, people have been dumping bonds. That's why bonds are going down this much. Now, but have a look at these last 2 days. A couple of things happened. So first of all, we had the on Thursday, we had the core PCE come in. This is a number that the Fed really likes, and the Fed really looks at it. It was expected to be 0.3%, but actually turned out to be 0.2%. So usually what happens is, let's see, on a day like this, US 10. Okay. Okay, so this was Thursday and this was Friday. We can see it's probably, okay, this is the US 10-year Treasury yields. It's probably better if I show you guys the TLT, which is more direct. This TLT is essentially the reverse of what happened with the US 10-year Treasury yields, except this is measured to 20-year, but they're similar enough. This is the bond ETF, which means bond prices are going up, and as we just saw in the previous one, yields are going down. This is it's a mathematical relationship where the yields US 10. So I just want to say, so for example, these are the actual yields going down from, like, say 4%, 4.5% down to 3.48%, which is actually my level. My target has been 3.47 to 3.51%, and people in my Discord will know this. I've been saying this for quite a while now. Okay, anyway, back to TLT. Just remember, TLT is a reverse of the yields. It's a 20-year bonds ETF. We've seen two major moves in the last 2 days. Check this out. So this is a huge bar, right? Look at the amount of money coming in, and look at it here. This is November 10th. There's a huge, look at the volume on this. The volume on this is incredible. Like, we haven't seen volume like this since this was March, right? Green volume. People are buying here, and buying here. Like if we look back, yeah, there hasn't been This is one of the biggest buying volumes. If you look past March, this would be one of the largest buying volumes in history, right? In the history of bonds. So it seems to me big money is piling into bonds right now. For what reason? So first of all, look at this. We said core PCE or inflation comes in lower. Now, what happens when inflation comes in lower is basically, so inflation comes in lower. That means the Fed is probably not as likely to hike rates if inflation's under control. So which means yields go down, which means bond prices go up. But they bought it in such a big hurry. It was a massive move with massive volume. And you think if bond yields went down, then on a day like this, then stocks, yields go down, and then stocks go up, right? Especially tech stocks. Let's have a look at what happened to tech stocks on that day. Whoa. Where is it? Okay, here's the QQQ, the NASDAQ ETF. Come on. Tech stocks on Thursday, actually, this is Thursday, right? Actually went sideways. When yields fell that much, tech stock didn't move at all. What does that mean? That means basically it's the market is not thinking, oh, inflation's going down. Great, that's party. The market is saying, okay, even though inflation's going down, we think interest rates are going down. That's why yields are going down. But people are not buying risk assets like the QQQ, which is tech stocks, right? People are not buying it. And in fact, people are buying bonds, which is a flight to safety. That's risk off. Okay, now have a look at this. Have a look at what happened on Friday. Friday, the non-farm payrolls came in, and it's 200,000 jobs to be added, expected. 263,000 jobs were added. So the economy is strong in that sense, if you believe these numbers. Now, the Fed believes these numbers, so if the economy came in strong, that means basically, the Fed is more likely to hike because they're not worried about people losing jobs yet. So, which means yields are going to go up, bonds go down. But no, again, people went in and bought bonds. See, another huge green bar. So we've had two massive green bars, and look at the volume. Look at this volume, right? This hasn't been seen since like March this year. And okay, so look at the actual numbers here on TLT. Basically, this was the move in March. This is the move today. If you look past March, this is the highest amount of inflows, right? Daily inflows or weekly inflows into TLT ever, right? Say TLT post second biggest inflows ever, right? So a lot of money are rushing into bonds on good news or on bad news. So what's that telling us? That is basically saying maybe people are looking at a risk off situation. Let's have a look at a couple other things to see if this signal is accurate or not. For example, we have the consumer staples. See, this XLP is consumer staples, right? XLP. Divided by the SPY. So we're comparing consumer staples to the SPY, to SP 500. And what we see is this large downward trend, which means consumer staples underperforming the SPDR, the SP 500, underperforming until November 30th or December, then start outperforming. Well, look at that. Basically, this is the market telling us consumer staples, a very stable and safe sector, is going to be doing better now. Why are big money moving into a safe sector? Like if the economy is so strong right now, why would you buy consumer staples? Consumer staples like, food and drinks and, like cheap clothing, like, shopping and retail. I mean, like supermarkets, Costco, Kraft and Heinz, ketchup, those things. Doesn't matter if you're like dying. It doesn't matter if you're unemployed. You're still gonna need food, right? Those sort of industries. It's extremely defensive. So they've been in a booming market. Of course, they don't do well because you want to buy the risky stuff like Tesla or NIO. But during a downturn, people buy that instead of buying the S&P 500. So we see it in this large rising pattern, and now it's formed this wedge. It's this close to breaking out. If this breaks out, that's basically the market screaming that big money is running for cover right now. Okay, another one we can look at is XLU, right? XLU is basically the utility, say, spider utilities. Utilities, again, is very boring because, hey, think about it, like utilities like electricity, water, those sort of companies, they don't make much. They're like kind of like bonds because they don't really grow, but they generate a healthy dividend. Now, what happens with them is basically they're seen as the closest thing that the stocks have to the bond market, and they've basically recently had a massive crash and broke through that trend line, that massive trend line that's held for the last 2 years for this entire bull run. And people thought, oh, okay, well, why would you be worried about risk off if utilities are crashing? But look at this. This is like, literally like Lazarus rising from the dead and coming back to life. It's broken right above this trend line and it'll probably bounce up. Again, if utilities are doing this, utilities are coming back from the dead. Now, this is just like TLT, which is long bonds coming back from the dead. You see what I mean when I make it. Look at that. Yeah. I mean, look at this. So bonds, the safe haven asset, right, which rich people buy to protect themselves, has gone from, wow, actually, should have done this. Yeah, okay. This is since March 2020. Okay, since March, it's gone from $180 down to $90. So it's made a 50% fall. Like, imagine how some rich folks are feeling right now, and then now it's making this massive pivot. So on the second largest volume ever on Thursday, right? Basically, a lot of money are rushing back into bonds, rushing to buy utilities, rushing to buy consumer staples. They're not buying the risky stuff; they're buying the safe stuff. So, what does that mean for the stock market? Now, let's look at the SPY. This is the weekly chart. Everyone's been saying, it's basically going to get rejected off this line. Yeah, could completely easily happen. But since it's done it once, twice, third time, fourth time, I think no one's going to be surprised if that happens, but I think it's probably a little too, too convenient. I personally, I'm expecting it to fake out, right, and then bounce up, maybe and then when you break this line, everyone's like, oh, we're in a new bull market. See, I told you, we're in a new bull market, right? Because you've had this trend line or channel that's guided the S&P 500 down for this entire bear market. Once this breaks, people are going to say we're in a bull market, and everyone piles in, everyone buys, right? The late buyers come in, the big calls options get bought, and what happens is basically it gets rejected at this 415 and goes down. Could be a massive bull trap, or bounces off the line here, comes to this level of resistance, right? 425-ish area, 425 to say 430-ish area, and basically make a double top compared to this August top, and then go down again. And so as we can see, if I put this on a daily chart, we can see a lot of we can see a lot of tops and bottoms around here. See this area of 450. This is 415. We can see tops, a lot of bottoms, and this is 425, right? We can see tops, bottoms, almost a bottom, and almost the top here. So I'm expecting it to bounce up and for everybody to then scream, bear market is over, we're back in the bull market, and then turn maybe around 415 to 425. Even with the outside chance of making it going to 430, making the top somewhere around here, right? And early Jan, Feb, and then turn down. May not go all the way down, might bounce again around here, but that's the scenario I'm looking at because we are heading into a major risk-off situation. And if it's going to be risk-off, chances are it might break this low at 360 and head even lower, might head to that 320 level. But we're getting way ahead of ourselves. So basically, I'm expecting to break out of this channel, right? Fake everyone out, like pull back, fake everyone out, and then bang, something like that. If you're still holding stocks, like myself, I've sold most of it. Well, I actually didn't buy much once it was like climbing higher and higher, but I am holding a small amount of stocks in things like defense because I thought, okay, there's a war between Russia and NATO could happen. So I bought some defense stocks, still holding some gold stocks. I might look to get out of dollar cost average out of some of those when it bounces up. This is not financial advice for anybody else. It's just my own personal situation. So overall, I want to emphasize, please try to understand what is happening with this risk-on, risk-off situation in the market. It's actually very, very important. This is a classic signal that is coming back. The only thing we need for it to work is for the dollar to bounce. The classic risk-off is when the US dollar bounces as well. This is the shape I'm expecting. If you're on my Discord, you've seen this a number of times. So far, it's working out. So I'm not sure if it's going to follow this line, as tightly as I've drawn it. But I'm expecting the US dollar to bounce again. So imagine what happens in, say, Feb, March next year. You've got, or even earlier than that, you've got basically a rising US dollar. That's the classic risk-off trade. Basically, money flowing into the US, and you've got a rising bond market, and they're hiding in very safe assets such as bonds, and stocks are maybe rising a little bit, maybe going flat, or maybe going down a little bit. That's classic risk-off. Means all the capital that's being out there in places like Brazil, like Vietnam, England, all those places, they're now coming back, and they're now basically saying we need to get into the safest thing possible. That's getting the US dollar. What's earning good yields right now? 3.5% yield on the US 20-year bonds. Let's buy those. And then stocks, we're not touching that. QQQ, NASDAQ, we're not touching that. If we are seeing that in a few weeks from now, that's a major signal for the market screaming risk off. Hope you guys understand that concept. I will update you guys as time goes. So this is Pablo He-Man coming from the Bahamas. And hey, is that Sam? Sam Bankman-Fried. Sam. Anyways, I'll catch up with Sam and catch you guys.